difference between the fiscal stimulus and the monetary stimulus. So let's see some of the major differences between the stimulus. Fiscal stimulus is a government controlled one. Everybody know if there is any fiscal policy, that will be by the government of India only. The monetary stimulus is controlled by the Reserve Bank of India, or we can say the central bank of the any country. The government use fiscal stimulus package to influence overall supply and demand by cutting down the taxes, increasing the spending on the social security scheme, increasing the spending on the infrastructure. Where the monetary policy adopted the supply of money by increasing or decreasing the interest rate, depend on the situation in the economy. If the economy is going toward the higher inflation, they will increase the rate. If there is a deflation, they will decrease the rate, so that the money of the supply of the money in the market will increase. Fiscal stimulus is carried out by the government through direct spending and increase the hiring process and promote the employment and growth. If the government is spending like money on the infrastructure sector, government is spending money on the manufacturing sector, government spending money on the MSME, it will increase the employment level in the country. Monetary stimulus work in two ways. One, encouraging investment by business through reduction in the marketing interest rate. When the interest rate will decrease, then the businesses will get the more money to invest there. Increasing the money supply by injecting more cash to the economy, either by printing the money or either by changing the interest rate in the economy. So RBI can do this through a two-way. Fiscal stimulus package are the last resort, achieve the price stability, steady economic growth. If the any policy is not working, then the government will move toward the fiscal package, so they will increase the spending through their policy. Similarly, put extra money into the people hand during the time of recession. Like if the West is facing the recession now, they will be facing the next 1 year. So they will try to increase the amount of money in the people hand. So they have some power to spend the money. If they're having the money, then the economy will start growing slowly. So this is a difference between the fiscal stimulus and the monetary stimulus. And the major idea, monetary stimulus will be depend on the interest rate that is decided by the Reserve Bank of India. Either it will be increased, either it will be decreased. But fiscal stimulus is directly the spending of the government. Spending of the government on any sector, on infrastructure sector, on social security sector, on education sector, on manufacturing sector, on any sector.